Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Yeah, and there's definitely a lot happening right now.
Oh, absolutely. I mean, just to set the stage for everyone listening, it's May 12th, 2026. We're looking at a U.S. economy under President Trump, and, there's just this constant focus on inflation concerns.
No,
Yeah,
inflation and the shifting interest rates. It's a tricky landscape to navigate,
for sure. And right in the middle of all this macroeconomic turbulence, we've got Bitcoin hovering around $81,000.
which is, frankly, a number a lot of traditional finance folks never thought they'd see.
Exactly. And that brings us to the mission of our deep dive today. Because based on some recent analysis we've been reviewing, Morgan Stanley just launched the Morgan Stanley Bitcoin Trust.
Yeah, one of the ticker MSBT.
Right. And, we aren't just looking at this as like, oh, hey, here's another crypto product on the market. That's not the point. We're looking at a massive hidden shift.
A total structural shift, really.
Yeah. Wall Street is basically moving from being this reluctant middleman for crypto to actually turning Bitcoin into a core in-house asset management tool for everyday American wealth.
And that transition is huge because they're taking this raw digital asset and forcing it into a very traditional framework.
Which I guess leads to the first big question for anyone new to this. If you want Bitcoin, why not just go buy Bitcoin? Why do we need an ETF or an ETP like MSBT to do it for us?
Right, MSBT is an exchange-traded product, an ETP that directly tracks the spot price of Bitcoin. And to understand why that's necessary, you have to look at the friction of holding the actual digital asset.
Yeah, and I think a really good way to wrap your head around this is think about it like milk.
Milk? Okay, I like where this is going.
Hear me out. So buying direct Bitcoin is sort of like buying a live cow, right? You have to figure out how to feed it. You got to build a secure fence. You have to guard it against rustlers in the middle of the night.
Which, in the crypto world, means managing your own digital wallets.
Exactly. Storing private keys, worrying about hackers, not losing your password, and getting locked out forever. It's a lot of maintenance and risk.
It really is.
But buying an ETF, that's just like going to the grocery store and buying a gallon of milk. You get the exact same benefit.
Without any of the messy farm work.
Exactly. You just drink the milk. You don't have to shovel anything.
That's a great analogy. And, according to the data, the real magic of this ETF wrapper isn't even just avoiding the technical hassle of wallets and keys. It's about something called asset management utility.
Asset management utility. So what does that actually mean for the everyday investor listening to this?
Well, think about high net worth individuals or just someone managing a standard retirement portfolio. Holding direct Bitcoin is honestly a nightmare for them.
Oh, because of the taxes.
Taxes, inheritance, using it as collateral. I mean, try putting a raw cryptographic key into a standard American probate court.
Oh man, I can only imagine. The legacy financial system, like our 401ks and IRS reporting, it basically operates on, let's say, 110-volt electrical current.
Right.
It's built for traditional stocks and bonds.
Right. Assets with standard 9-digit identification codes.
Exactly. But Bitcoin is like this raw cryptographic bearer asset. It operates on 220 volts. It's a completely different architecture.
So if you try to plug that 220-volt Bitcoin into a 110-volt local judge who's managing your estate,
It completely short circuits. The judge doesn't know how to legally transfer a string of alphanumeric code to your kids without creating a massive legal headache.
exactly. But the ETF wrapper changes all of that. It acts as a universal adapter.
Right. It takes that foreign 220-volt asset, runs it through a converter, and boom, it fits perfectly into the traditional 110-volt outlets of American banking.
And suddenly it generates the standard tax documents the IRS expects. It sits neatly inside a recognizable brokerage account. It's legible to the system.
So it's super easy to pass down to your kids or report on your taxes.
Right. And if you want to take out a mortgage and you hold raw digital assets, legacy banks struggle to accept that as collateral. Their risk management software literally cannot secure a digital wallet.
Oh, but if you hold shares of MSBT,
The bank just sees a standard security sitting in a Morgan Stanley account. They can lend against that instantly.
because they recognize the wrapper, even if they don't fully understand the asset inside. That makes total sense.
That does. But while the wrapper explains why investors want it, it doesn't explain this really surprising strategy Morgan Stanley is using to actually get this product into everyone's hands.
Yeah, let's get into that because the data on this is wild. It's basically a massive fee war.
A brutal one.
Right. So recent data shows MSBT launched with this tiny management fee of just 0.14%, which completely undercuts the biggest players out there. I mean, BlackRock's IBD is at 0.25%.
And Fidelity's FBTC is right around there, too.
So, okay, put on your skeptic hat for a second. Why would a giant financial institution like Morgan Stanley willingly slash its own profit margins right out of the gate? I mean, is a fraction of a percent really worth fighting a price war over?
Well, you have to look at their distribution network. Morgan Stanley isn't actually trying to make a fortune off that 0.14% fee itself.
They aren't.
No, not at all. They have this massive network of wirehouse advisors and wealth management clients. We're talking millions of portfolios.
Right.
And they charge an overarching advisory fee for managing that money,
Right.
usually a percentage of the total assets.
Oh, I see. So there's a conflict of interest risk there.
Exactly. If an advisor is already charging a client a 1% advisory fee and then push that client's money into a Morgan Stanley Bitcoin fund that charges another high fee.
The client gets double charged. And it looks like the advisor is just padding the bank's pockets instead of looking out for the client's returns.
Exactly.
Yeah.
But by offering a dirt cheap in-house product at 0.14%, they avoid that bad optic. The advisor can say, hey, I'm putting you in the absolute cheapest option on the market.
Wow. So it's basically the Walmart shelf strategy applied to Wall Street?
How do you mean?
Like, you know when a major supermarket sells a rotisserie chicken at an actual loss? Like, they are losing money on the chicken.
Right, the loss leader.
Yeah. They just want to get you into the store. Because they know once you're inside, you're going to buy higher margin stuff. Paper towels, groceries for the week.
That's spot on. Morgan Stanley owns the ultimate financial shelf space. They've got these massive wealth management channels. They have the E-Trade platform.
So they don't care if they just want to keep all your money inside their ecosystem.
Exactly. Because if you stay, you'll use their margin lending, their cash sweep accounts, you'll trade other assets. They just don't want you moving your capital to an external crypto exchange.
Right. And, looking at the data, this strategy is clearly working. But it's also creating some massive winners and losers in the market.
Oh, for sure. The scoreboard up to early May 2026 is pretty revealing.
Yeah, so let's look at the numbers. BlackRock's IBIT is just the absolute heavyweight right now, right? Over $66 billion in inflows.
Yeah, they captured that first wave perfectly.
And Fidelity has about $11 billion. MSBT is definitely smaller since it's newer, bringing in about $194 million in its first month. But what's crazy is that they had $30.6 million on the very first day.
And then 0 days of outflows for the rest of the month.
Right. 0 outflows. That seems really significant.
It is. 0 days of outflows is a critical indicator. It means we are officially entering round 2 of the Bitcoin ETF era.
Okay, so if this is round 2, what was round 1?
Round 1 was back in 2024. That was just a messy fight to get the SEC to approve these things. It was about proving the basic plumbing actually worked.
And BlackRock clearly won that round by scooping up all the pent-up demand.
Exactly. But round 2, which we're in now in 2026, is totally different. It's a war over which financial titan can most seamlessly funnel their clients' existing traditional portfolios into digital assets.
Wow. So in this kind of environment, the high-fee products are basically doomed, right? Like Grayscale's GBTC, they've always had higher fees. They must be facing massive pressure to survive.
Relentless pressure. If you can get the exact same Bitcoin exposure seamlessly in your Morgan Stanley account for 14 basis points, why would you pay more?
You wouldn't. But you know what's fascinating in the analysis? The real winners here aren't even necessarily the funds themselves. It's the infrastructure guys.
The custodians?
Yeah, it's the classic gold rush analogy. Like
Right.
during a gold rush, the people who make the guaranteed money aren't always the miners. It's the people selling the pickaxes and shovels.
Exactly. And in this scenario, Morgan Stanley is organizing the gold expedition, but they aren't swinging the pickaxe. They partnered with BNY Mellon and Coinbase.
Right. BNY handles the accounting and cash management, and Coinbase holds the actual digital assets, the private keys.
They are the backbone. They provide the secure storage and the complex daily administration that makes the whole ETP function.
And the beauty of their business model is they get paid regardless of what the market does. Like if Bitcoin goes to 100,000 or crashes by 50%, the pickaxe sellers still get their fee.
It's an incredibly resilient model. And the data shows this pipeline is just expanding. It's not stopping at Bitcoin.
Oh, right. E-Trade is planning to offer direct trading for Ethereum and Solana now.
Yeah, and Morgan Stanley actually filed for a Solana ETF. They are building out a whole digital asset aisle inside their walled garden.
Which honestly, hearing about all these massive banks, Morgan Stanley, BNY Mellon, talking about billions of dollars, it makes the whole thing sound incredibly safe.
And that is exactly where we need a reality check.
Yeah, because to an everyday investor, you see a prestigious banking logo slapped on a product, and you assume it has the same protections as the boring, safe mutual funds in your 401k.
Right. But that is a dangerous illusion. The recent analysis strongly refutes that idea. MSBT does not, and I can't stress this enough, it does not have the traditional protections of a 1940 Act mutual fund.
The 1940 Act, that's the law that puts guardrails on normal retirement funds, right? Like forcing them to diversify.
Exactly. It mandates diversification, limits leverage, requires independent boards. An ETP, like the Morgan Stanley Trust, operates completely outside those specific guardrails.
Wow, so it really is just a mirror of the asset.
Just a mirror. If some global event happens or inflation fears spike and the price of direct Bitcoin plummets 50% in a weekend.
The Morgan Stanley ETF will plummet by the exact same 50%. The fancy Wall Street wrapper doesn't magically erase the wild volatility of crypto.
Not at all. And you still have underlying custody risks. Even with Coinbase, if there's an operational failure with the digital keys, the wrapper can't save you from that.
But wait, let me push back on that a little bit. Doesn't having all these massive, slow-moving, conservative wealth managers buying Bitcoin actually stabilize the price? Like, aren't the adults in the room going to smooth out the wild swings we used to see?
You would think so, right? But it introduces a fascinating paradox. It's a phenomenon called herd behavior.
Herd behavior.
Yeah.
Yeah.
You have to understand how modern wealth management works at scale. Advisors aren't handpicking stocks for every client every day. They use automated model portfolios.
Oh, like templates. So they might assign a standard, say, 1 to 3% crypto allocation for all their moderate risk clients.
Exactly. So every time a client deposits a paycheck, the computer automatically buys a little more of the ETF. In good times, that creates incredibly steady buying pressure.
So it does act as a stabilizing floor.
In good times, yes. But here's the catch. If a massive market panic hits, all these computer models at all the different banks operate on the exact same risk management rules.
Oh, wow. I see where this is going.
Right. They use strict volatility targeting.
Hmm.
If the broader market drops and portfolio risk spikes, the algorithm's only job is to reduce risk. It mechanically liquidates the most volatile assets.
And Bitcoin is always going to be one of the most volatile assets in that portfolio.
Exactly. So instead of individual retail traders panicking at different times, you have the largest financial institutions in the world automatically triggering massive sell-offs.
At the exact same millisecond.
Yes, it creates a standardized massive wave of selling pressure. So institutionalization brings liquidity, sure, but it also brings the immense danger of the herd.
That is terrifying, honestly. The herd moves together, entirely without emotion, just executing billions of dollars in liquidations because a mathematical trigger told them to.
That's the reality of a financialized asset.
Man. So just summarizing all of this, we have really gone from, what, a decade ago? Rogue computer programmers mining digital coins in their basements, trying to build a new system, to today, in 2026, where the biggest banks in America are fighting brutal price wars over a BIF rate 1% fee, just so they can put Bitcoin into your grandma's trust fund.
It is a complete 180-degree turn.
Which leaves us with a really provocative final thought for everyone listening. Think about why Bitcoin was created in the first place. It came right out of the 2008 financial crisis, right?
Right. It was explicitly designed to bypass the legacy banking system.
Exactly. It was this rebellious anti-bank technology meant to let regular people hold value without relying on giant central custodians or clearinghouses.
And now?
And now, if Wall Street succeeds, and based on the data they are succeeding, they are turning Bitcoin into just another boring, perfectly regulated, highly controlled financial product sitting on a traditional bank's ledger. The digital keys are locked in BNY Mellon's vault.
It's just a ticker symbol now.
Right. So if that's the ultimate destination for this technology, does that defeat the entire purpose it was invented for? Did the financial establishment not just adopt the revolution, but completely swallow it whole? It's something to chew on. Don't forget to subscribe and hit that like button.